cuts interest rates, it's going to be good. Good for people who want to borrow, people that are interested in taking out a fixed rate or even a variable. So time in the market is always the more important thing. Sticking in the market for the long run and not trying to time entry and exit is always the best thing to do. An ETF is usually about 20 basis points more returns on an after-tax basis.
Professor Derek, welcome and thank you for agreeing to do this podcast with me. You are a professor of finance and you have education from Stanford, University of Chicago, University of Southern California, all the big names in finance and economics on your resume. And I'm just honored to be chatting with you.
Well, yeah, thank you for having me on. I'm happy to be here.
So let's start with this hot topic of inflation. Yesterday, inflation's monthly report came, and it beat the expectation on the upward side, right? And stock market fell. So, what do you take from that particular part? What do you think inflation is doing, and how is it affecting?
Yeah, it came in stubbornly high. I think the market got ahead of itself a little bit. Excuse me, a month ago when they started to really anticipate that the Fed was going to do 4, 5, 6 rate cuts over the next 6 to 9 months. We even saw it really in the 1 year Treasury yield. The 1 year Treasury yield back in beginning of December went from 5.2 all the way down to about 4.6. A really big move in a month or so. And I think the Fed was trying to communicate all along that, this we're not going to see this, drastic decrease in rate cuts that the market was anticipating, and obviously it reversed in the past week. So I think inflation's coming in a little bit stubbornly high. Nothing to freak out about, but it's a little bit more persistent than people thought.
Yes, I agree. It is not transitory that Fed said in 2022, I guess. So, but I think more of it is like Volcker effect. Like Fed doesn't want to uh, take the foot off from this rate uh, so earlier that it will be like a repetition of Volcker episode, right?
Yeah. Yeah, I mean, I I think legacy is something that a lot of Fed chairmen obviously care about, and probably Jerome Powell cares about. He doesn't want to be, I believe it was Arthur Burns, the Fed chairman before Volcker in the 70s, that kind of, screwed it up a little bit. Messed up taming inflation in the mid to late 70s. So I think that's probably weighs heavily on his mind, and he probably would want to overshoot and to cause 1% inflation than to never get there and have persistently high 3 or 4 or even worse. It goes back up to 6 or 7%.
I see. I see. So do you what probability do you put on this March rate cut? Almost zero, zero.
Yeah, I think with the data that came out, it really pushes it down. If I had to just throw out a number, maybe a 20% chance that it happens, or even lower. But that's just putting a number on it.
Okay, okay.
Yeah.
So let's say sometime this year, uh, Fed cuts the interest rate, right? So what are the implications of this Fed interest rate cut for, let's say, mortgages, my credit card, my
Mhm.
student loan, etc.?
If the Fed cuts interest rates, it's going to be good. Good for people who want to borrow, people that are interested in taking out a fixed rate or even a variable mortgage. Um, Obviously one cut doesn't matter too much, but if they do 4 or 5 cuts over the next year or two, that significantly reduces your mortgage. Um, maybe reduces if you have credit card debt, maybe reduces it a bit.
Yes.
It obviously is going to have effects in markets, right?
Yeah.
Small caps very much rally whenever the Fed cuts rates, or interest rate sensitive companies like a lot of the tech sector really go up when the Fed cuts rates.
Yes. That's right. So since you're talking about investment, you wrote an article talking about uh, time in the market and timing the market. So what are these two concepts, and which one is the better for like retail investor like me, you, or somebody who is just starting to invest?
Yeah, it's a really hard one. Most people just feel innate like they can time the market, but we know from not just any work that I've written, but from 50 years of data that nobody, maybe 1 in 100 people, can really time the market over any significant amount of period. But it's just innate that you think you can pick the bottom and you think you can pick the top, but it just never works out. So many people, you know, the natural human intuition is when markets are going down, you try and hold on for as long as you can, but most people just get spooked and sell out at the bottom, which is the exact opposite thing you want to do. So it's near impossible to time the market. The popular press will always come out with something really cool, like uh, a story about a set of hedge funds timing the housing collapse in 2007 and making money off of that. But that's again 1 out of 100 can do that.
Yes.
So time in the market is always the more important thing. Sticking in the market for the long run and not trying to time your entry and exit is always the best thing to do.
So what you are saying is I should keep investing no matter what is happening in the market.
Yeah.
But right, right.
Yep.
But
Yep.
whatever happening right now with this cheap frenzy, Nvidia and everything. Anyway, I read the headline or something. This particular stock is going 10% higher in a week or so. Even sometimes in lesser than that, right? So it is very hard not to jump on this bandwagon. Right?
It,
Psychologically, it is very difficult when I read it. So for people who are tempted to join these kind of rallies during market volatility, what are the ways I can avoid joining this bandwagon and get burned?
yeah, it's so hard because it's really tempting to ride momentum trains or even to try and predict when it's going to all pop. I know it's fun sometimes, right? I got caught up within it years ago when I thought Tesla was way overvalued, and I was very much wrong on that. So there's situations where you have very strong convictions and you think that things are overvalued or undervalued. I would suggest if that is your personality, which a lot of us have, maybe have 5 or 10% of your money that you actively allocate. And then the rest 90 should be in passively managed portfolios. So just kind of either dollar cost average or whatever kind of strategy you want to use. But I think most people would agree, having 90% of your money in long term, ETFs or whatever your preferred low cost index options are. And then, maybe 10% of your money you can play around with, and no
Yes,
harm, no foul, but you're probably not going to make too much money off of that 10%.
I agree. So I think that is a good suggestion, just to like invest into ETF and sit back. You don't have to read headlines or you don't have to get nervous a lot. So given an opportunity between ETF and mutual funds, what is a better choice, let's say, from tax perspective?
Yeah. So so we should take a step. Um, if you are holding mutual funds or ETFs in like a 401k, then it's always good to point out that they're basically equivalent, because you're protected from taxes and the tax features of the two. Um, but if you're holding in a taxable account, it's almost always true that the ETF is more tax efficient, and usually has a lower expense ratio, but not always. When we compare to like ETFs from the same, when we compare a mutual fund and an ETF from the same provider, we kind of measured the tax efficiency, and in general, an ETF will add about 20 basis points more per year, than the mutual fund. So you can kind of juice your returns. Again, this is comparing same fund family, same cost structure, same everything else. An ETF is usually about 20 basis points more returns on an after-tax basis.
I see. So what you are saying is ETF is a better choice
Correct.
tax-wise, right? But
Correct.
if you consider that 20 basis point or zero point 0.2 percentage point over long period of time, that can be magnified into huge amount.
Oh yeah, yeah. That it really rapidly magnifies. You know, within 5 years, you're well over 1% extra in returns, and then so you just do the math from there. It could easily add, probably over your lifetime, 10% more to your savings if you're saving for 40 years or so.
I see. So there are multiple kind of ETFs, right? Or mutual funds, passively managed and actively managed. So which one is better? Is there any historical data to choose? Okay, this kind of fund is better. So first of all, what is passive and active fund? And yeah,
Sure, sure. So yeah, we usually separate, mutual funds or even ETFs come in active and passive. Um, but we'll focus on mutual funds to make it simple. In mutual funds, you can either have a manager that just tracks the S&P 500, for instance, or you can have a manager that goes out and forms their own portfolio, their own choices. So, you know, we call the latter one active. So if the manager is maybe picking just 30 stocks to hold, that is an active mutual fund. Now a passive one would be one where the mutual fund manager just allocates to the S&P 500. Excuse me. And kind of data over the long run shows that, the passive strategy, the passive mutual fund, really kind of outperforms over the long run. Um, in any given year, you can maybe say 40% of active mutual fund managers outperform their index, sometimes just 30%. Um, but yeah, so over the long run, it kind of makes sense to go with just the index.
so why is it? So you are saying that index fund is better indirectly, right? So why is it difficult to beat the index fund?
Yeah, for a variety of reasons. I think, over the past 50 years, markets have become more efficient. I think nobody would argue that. If so, that's reason number one. It's just really hard for a mutual fund manager to beat their benchmark. And there's an argument that if you really are a talented stock picker, you're not going to be a mutual fund manager for long. You would go and be a hedge fund manager or go into private equity or some other line of business. So maybe if you really are talented, you would go to an area where you can grab more of your returns. And this is due to the kind of the compensation profile of mutual funds. So I think there's a number of reasons why, you know, um, mutual fund managers are just going to underperform over the long run.
I see. I see. So I would like to get into some interesting part of option trading. Okay. So
Sure.
during pandemic, There were a lot of videos and news that people are getting rich overnight because of this put option, call option. Robinhood came into play, this market, and like these young kids were getting rich and rich. So, how much? So again, it is going back to timing of the market. How is that true that option trading is? What can you say about option trading?
Yeah, I mean, yeah, it's how do I say it? It's kind of unfortunate. You have Wall Street bets out there. I go on Wall Street bets. I'm sure lots of other finance professors do. Lots of kids are on there. Kids that are 20, 25 years old are going on there and just seeing all the crazy risky positions that people are putting on with their entire life fortunes, or they've saved up 20K or they saved up 50K and they put all this money on close to single bets, right? Not following diversification, not doing highly levered bets, which is what options can do. You can buy an out of the money option, which can be really levers up your returns. You put down $1 for this option for a single one share of the position, and with that $1 you have the chance of winning 100. um,
Yes,
and that's the problem. It looks very enticing, and so it will happen 1 out of 200 times. You'll hit that 1 to 100 payoff. But if it's only happening 1 out of 200 times on a obviously on an expected value basis, that's not a good proposition.
yes,
But social media magnifies that because the one person that hit big on a 1 out of 100 payoff gets all the attention and makes it look like anyone can do this. And so that's the unfortunate thing.
yes. I agree. Means there were news in the Wall Street Journal and whatnot that people are committing suicides because they are using these leverage bets and whatnot. But yeah, the same thing happened with the Bitcoin, right? People were crazy about this. In fact, Bitcoin hit 50K yesterday, I think 50K.
Uh,
So
yeah.
how do you think the Bitcoin is uh, affecting the traditional financial markets? Since the ETF related to Bitcoin also came last month.
Yeah, that's an interesting question. I'm by no means an expert in the Bitcoin space, but it one thing I've noticed, it it's very much a momentum play, right? It's very hard to come to a fundamental value for Bitcoin, and so it's kind of seems like you're measuring inflows and outflows and what sentiment is to try and capture where the price is going. Um, so that's one thing I would say about Bitcoin. But again, I've never traded Bitcoin. I kind of just did a buy and hold strategy from very long ago. Just kind of had the position that maybe this thing will work. I have no idea. Maybe it's a 20% chance that this thing will work in the long run, but I'll allocate 2% of my portfolio to it and just keep it at that, and you know just go for the long haul. So
Yes, I think with these speculative assets, it is better to be safe than sorry, I think.
yeah, exactly.
But I think what happened in the last year with this Sam Beckman, right? I, I don't know if I'm pronouncing his name rightly. He started this uh, a company and then he's in jail right now. So, what do you think is the role of regulators as per as these coins, Bitcoin and other coins are concerned?
Yeah, again, it's that's another interesting feature of Bitcoin. It seems like the narrative changes very frequently about Bitcoin. First, if you go way back to when it first started getting popular press, this thing was going to take down the US dollar. And then it kind of shifted to this was a way to move yourself out of the banking sector completely. And it was completely decentralized and without any regulation. And then the narrative shifted again. And now we're into a narrative where they want regulation because they want to be legitimized. So it's a very odd speculative asset to be in, where the narrative that is driving it changes, right? I think gone are the days where you had like a lot of individuals that thought that this was the tool that you could just avoid all regulation with, and you could exist outside of boundaries by using Bitcoin. And now it's kind of been co-opted, and it wants regulation so it to reduce volatility of the asset. So I think that's an interesting thing that's happening with that coin. Yeah.
So, in terms of technological development, another thing that came uh, into the financial sector recently is AI, right? So, how do you see this particular AI and blockchain is affecting financial markets?
Yeah, another good question. I wish I was an AI expert or a blockchain expert, but yeah, I think we keep seeing more and more articles about how AI is going to eventually affect white collar work. Right? It's not going to have much effect on blue collar work, but there's a large segment of the population, mainly in the white collar space, that probably their jobs could not can be completely eliminated, but be cut down with the use of AI, right? If you're doing heavy writing and I'll just throw, I don't know, maybe some features of law, some features of marketing or advertising, um, are probably going to be affected by this. Blockchain is another interesting one. I wish I knew. It seems like it's a valuable technology. It's another thing. It's also funny to watch how trendy these things are. Blockchain was the key word that was in all sorts of press statements and annual
Yes,
reports by companies year 2017 to 2022, and now that's gone completely, and now everything is AI. So it's really interesting to see how trendy these things are.
yes, I agree. I agree. Right now, the buzzword is AI and NVIDIA. Everybody is talking about those things. But I would like to shift to your university now. So you
Sure.
are a founder and you are a director of this student managed fund, right?
Mhm.
So what is it? First of all, what is it, and what was the motivation behind starting this particular fund?
Sure. Yeah. So a gentleman named Trevor Montano, who was an alumni of GMU, approached me maybe about 5 years ago, and he really took the lead here, and we were able to secure quite a bit of money from the GMU endowment. So this is endowment money, and the GMU endowment gave us the money and said, you can manage this money as long as your track record is good, and you follow the S&P 500. Nothing exotic, no going into derivatives, no going into alternatives. As long as you follow the S&P 500, we're okay having some finance students manage this money. And so that's kind of how it started, and we've had a good track record so far. And we report on an annual basis to the board of trustees about our performance. And at any given time, you might have about 10 individuals managing the money on a daily basis. And the students make all the trades, make all the decisions and all the trades. Try and minimize trades. So maybe we're only doing about 5 or 10 trades a semester. But yeah, that's kind of the structure of the fund.
I see. But if I were a student, I'm studying, let's say I'm going to college, taking my courses. At the same time, I'm doing this investment thing. I'm participating in this fund. I don't know how many hours I can devote, how much time I can devote. So, what are the risks involved in this particular fund? When you are managing the university's endowment, what are the risks involved?
Yeah, the risks are, I guess, would be the same as kind of managing any fund. that's trying to track a large cap index. We have policies in place where if a stock falls 20% or more relative to the benchmark, we need to cut it immediately. So we kind of have these policies in place where we're watching for big earnings announcements and things that can really move the stock. But yeah, I would say the risks are comparable to anybody that's managing an S&P 500 oriented fund. One thing that is unique with the students is obviously during summertime, there's a little bit less attention paid to the fund just because they're out of school. So you, as the advisor, need to get them to do their work. So that is one risk.
So let's say I'm trying to invest now. I'm a student and I'm trying to start investing my own money, some $1,000. So where do you think I should invest as an individual? Of course, this is not financial advice and anything, but where would you suggest me to? That's my first question. Second question is, what should I read for investing? What kind of books? Do you have any suggestion in terms of books?
Yeah, that's a great one. I think yeah, if you had $1,000, $1,000 is a little. I guess you could almost with that level of money, maybe just sticking with ETFs or sector ETFs and maybe making familiarizing yourself with that. Just because even with fractional shares, you're not going to be able to buy too many. Um, but in terms of books, always going back to the classics. You know, Value investing is not in vogue right now. It's not too popular. But understanding Dodd and Graham and anything that Buffett has written, I think are still helpful. It's not these are kind of timeless, or Burton Malkiel, another great investor. I I think these are interesting ways to look at markets. I know there's a lot of now different ways to look at things and writing momentum and other features like that. But I would still go back to the classics as a first step just to read them.
I see. So
Yeah.
apart from book, do you like follow any particular news outlets to familiarize yourself with the financial market
I will
activities?
definitely plug this because I make my students listen to this all the time. There's a phenomenal, even though I don't work for Bloomberg, obviously I write for the journal, on a monthly basis. But Bloomberg has a podcast called Odd Lots. A weird name for a podcast, but it's for any student that out there that's listening that wants to learn about finance. Odd Lots is great. It's hosted by two of the Bloomberg anchors there, and it really goes deep into one issue for about an hour every few days. So highly recommend that.
Great, great.
Yeah,
So so I'm going to put you in a spot. So you
sure.
are basically fund manager, right? As an advisor, but basically it is a fund manager. You are a teacher, you are a researcher. Also, you write for these journals, right? What is your favorite role out of these four?
Um, well, yeah, interesting. I would say surprising. I like the teaching aspect. Obviously, writing and doing research is fun, but interacting with students, whether it's through the SMIF or through classrooms, is fundamentally fun for me. I like educating students, and I like the interaction there. So that's probably the best part of my day.
I see, I see. And in terms of, apart from teaching, in terms of research, what are you working on right now? I do remember from your website that there is an interesting paper about football you're writing. I think it is under review at Journal of Sports Analytics. So can you please tell me what is this paper about? What are the findings? And so you are a finance person and you're going to the NFL football. So what was
Yeah.
the motivation of that particular paper?
So that one, that's an American football one. I have a fun uh non-American football one, whatever you want to call it, soccer. So that American football one is on the value of second and one. So that was a fun paper to write. Still working on it. And basically, the idea is, you know, you have an embedded option, I guess you would call it, in second and one. A lot of NFL teams just run the ball to pick up the first down, but by doing that, you reset the chains, um, and you don't take advantage of the fact that 2nd and 1, you still have, if you miss the play on 2nd and 1, you still have 3rd and 1 and 4th and 1 to reset the chains, as they say. And so we kind of look at the value. Excuse me. We look at the value of 2nd and 1 in that one. In the English soccer one that we're hopefully coming out with soon, or sorry, you know what I mean, English football or whatever you want to call it. We look at there's about 7 or 8 publicly traded soccer teams out there. So we look at kind of, does a win or a loss actually affect the value of the soccer team that is publicly traded? And we're kind of looking at what games actually matter to their share price, if any. And we're still testing that.
I see. That's interesting. So
Yeah.
you are still working on it, and we don't have any like results yet.
No, we're still, we can't release any results because we want to be positive, of what we're saying. But it'll probably be out in a month or two, or
I
rough
see. I
draft
see.
will be. Yeah.
I see. So yeah, I'll be looking forward to that paper. And Professor, thank you so much for talking to me.
Well, thank you for having me.